Harrison, how are we doing today?
Doing great. It's been a couple months since I was on the full show with you, but yeah, excited to be here as always.
Well, we got a full show, as you said, to kind of dive into. So let's get into it. As I said, we're going to start with investors have a false sense of safety in the stock market. Now, I was reading this article actually from the Wall Street Journal, and this is where a lot of the information came from. And it just was so pertinent to where we're at today. And there's a psychologist by the name of Gerald Wild, and I believe he actually has passed away here pretty recently, but he came up with the term homeostatic years ago. And I believe it just totally fits where we are. It essentially means that when the environment comes to feel safer, and the key word is not is safer, but it feels safer, people's behavior becomes riskier. And I think that's so similar to what we're seeing in the stock market today.
Yeah, I mean, it's definitely a psychologist would come up with that way of thinking, but it's basically saying as things go up, people think that that'll just continue. So they're okay taking on higher levels of risk, maybe only buying a small number of stocks as opposed to a more diversified pile of stocks, maybe being more comfortable with leverage, maybe be more comfortable with, whatever it is. They're like, oh, well, this will just, we're creatures of habit and we're conditioned maybe to think that things will just kind of continue as they have been, maybe from a short time perspective. So the last couple of years, things have been pretty easy. Well, maybe I can make a little bit more because it'll, maybe it'll just continue.
Yeah. And, sometimes I think for people looking at the stock market as an example isn't the best example. It's not as relatable. And, he being a psychologist didn't come up with this term for stocks necessarily. He used another great example to kind of put this in retrospect here. But he said that, when people are looking at driving, well, they'll probably drive faster in a big SUV than a little tin can of a car. Going faster in a big car does not reduce your risk of getting in an accident, but people feel safer. And that is where, again, you can look at the stock market. It's like you go up every single day, and you might be doing risky things right now, and you're almost getting this confirmation bias that, well, Wilsey Asset Management says I'm taking a lot of risk, but they don't know what they're talking about. I'm up 100% this year. Okay, congrats. You're up 100%. But what happens next? And you have this confirmation bias that you believe things are safe because you've done well. That can be a very, very dangerous path to go down because things can turn quickly and all of a sudden those returns dissipate. And I loved your point too about, well, a 10% gain, maybe a 15% gain. It doesn't become good enough. If you've achieved those, you think you can get better. And now you're looking for a 20% gain, 25% gain.
It's there. Why not take it? Yeah, I'll just, what's done well, I'll just keep buying it. And, but I mean, I think deep down, all of us know that you shouldn't be able to make 50% a year. If you're doing that year after year, that cannot be consistent. And if it was, with compounding, it doesn't take very much time to accumulate massive amounts of money.
Yeah, and I think it's, you say deep down we should all know that, but I think there's some that don't. I think,
I'm telling you right now, 50% a year is not normal. 20% a year is not normal.
15% a year, long term.
Long term. I mean, the
Not
S&P
normal.
long term is like 10%, and that's looking at it right now after this huge bull run that it's had. I mean, it's at highs. So, through the ups and downs, an 8 to 10% return is normal. That doesn't mean that happens every single year. It almost never happens in a singular year. It's either, up 15, 20. We've seen, 30, 40% returns in a single year. On the broader market, we've seen down 10, 20, 30, 40% in a single year. So it's never like 8 to 10% usually, but on average, 8 to 10%. So what that means is the more years you have of higher and higher returns, that's not consistent. At least long term, that's not been what's happened.
Like we looked at a stock last week, and I forget which one it was, but if you look at the 10-year return, I'm going to say it was up like 110% or something, but the 5-year return was flat. So you had a great 5-year period, and the next 5 years was very lackluster. And you have to understand that's how returns work. You can have a great 10-year analyzed return rate, but it could all come in a very small subset of years. And if you weren't in it during that small subset of years, your returns, your personal investment returns, could be terrible. And this whole concept of risk that people are taking, we keep talking about it. We keep looking at these numbers. And worry that so many people don't realize the amount of risk that they're taking with their investments because of this, again, homeostatic concept.
And the opposite of that is true as well. Right now, things have seemed easy, so people are taking on larger amount of risk without understanding that that's a larger amount of risk. But that's why the opposite side of the spectrum is when there is a lot of volatility in the market, when things are down, that's when annuity sales are at their largest, because people are so afraid that now they go to something that's deemed safe. Annuities are terrible investments. I hate them.
We'll talk more about that.
But that's what I mean. When we go through periods of volatility, people gravitate toward those annuities because they're safe. So they perceive a larger amount of risk in those times, so then they're not comfortable taking any risk at all, which I don't really like to think of the stock market as risky. I like to think of it as volatile, so it goes up and down in the short term, but long term,
it can be very risky if you do risky things.
Yes.
With it, but if you're investing properly, it's
you're
volatile.
investing, well, risk is the chance that you will lose money over, I would say, a long period of time. And you can't tell me that over the long term the stock market is risky, because it's literally every single time it's gone down, it's come back, because it's at an all-time high right now. Yeah. So it can be volatile, and there are things in the market that are risky that potentially would go down because they're overvalued and they're not worth what they're trading at. So those go down. But a good diversified portfolio, at that 8, 10, maybe 12% on average per year, that's a sustainable, I would say it really has no risk, but it can be volatile.
Yeah. Yeah. And, when you look at the market today, we've talked a lot about different things that we view as risk. We've talked about the margin. I mean, that scares the heck out of me. One other thing is the zero-dated options. I mean, that is just pure gambling on the stock market. We talk about these AI stocks, these tech stocks, the valuations on so many of them. That is risk. But there was another stat that I just saw recently where I'm like, gosh, you just keep finding these private investments. If I didn't mention that already, that's another thing that worries me. But what I saw was there's been 672 launches of new exchange-traded funds so far this year. And according to this firm, FactSet, which is a financial analytics firm, it said 28% are tied to a single stock and 25% are leveraged. And I was going to say I loved this, but I'm going to say this scares me. And at least 3 seek to double the daily gains or losses of our favorite item, cryptocurrencies. I mean, these are not ETFs that, when you tell somebody you're taking an ETF strategy, many times they're like, oh, I'm taking low risks and I want to invest in ETFs and get a broad pool of investments. I have my own qualms with that argument, but now you're taking this where these ETFs are not safe at all. These are pure risk gambling instruments that I would say at the end of the day, and it's just another area of the market where leverage is kind of sneaking its way in. And leverage, as I've talked about many times, can be so detrimental in the long term. All of a sudden that leverage tilts over, things just fall apart. And there's so many areas of leverage that you don't realize in the market, and it just scares the heck out of me.
Well, I think of 600, I mean, I didn't know that ETFs were being created that often. 672, that's a ton. But
there's more ETFs now, I believe. I'm going off memory here. There's more ETFs than stocks now in the...
What?
Yeah.
How?
Because they keep creating all these different things.
I mean, there's like thousands of cryptocurrencies out there, I guess. But with 672 launches this year, if 28% are tied to a single stock, that's like 190. 190 ETFs this year that are just tied to one stock. So, and then 25%, so like 170-ish, are leverage. So even if you're not borrowing money yourself, these funds are borrowing money, and that's an extra degree of actual risk there. But I just think those numbers are so insane. 190, 170 new ETFs that have that immense risk to it. We talk about the stock market long term not having the right risk, but that stuff is extremely risky. That's pure risk.
That's
right.
Pure gambling. And I was going to say one thing. I want to move on here to the next thing, but I had a conversation with a gentleman this past week, and people who listen to the show know we are not advocates of cryptocurrency. I think it is one of the most dangerous investments out there at this point in time. It's nothing. I'm going to put that out there. There's nothing. People that talk about it can't explain it fundamentally as a reason why you should buy it. But I was talking to this gentleman, and I'm like, I don't like crypto. And he said he wasn't investing in crypto, but he was trying to explain to me why crypto was valuable. And he used the example of saying it's like a sport trading card. And I'm like, well, number one, that's a terrible investment. I'm not going to buy a sport trading card. Number two, how does that relate to crypto at all? But when you look at it, it's like, I'd rather buy a sport trading card because at least that has emotional value. Like, I grew up watching LaDainian Tomlinson. I'm like, I would pay more for a LaDainian Tomlinson trading card than I would a one share of Bitcoin or one Bitcoin.
Well, well, Bitcoin's what, $100,000 right now? So you went
All else equal.
you're gonna buy a trading card for $200,000.
Let me see. I think there's more value to me
Right.
in a trading card of
Right.
LaDainian
Your
Tomlinson
your
than a Bitcoin.
version of intrinsic value of those two things are different, right?
But what I'm looking at is just, I have never met a single person in these cryptocurrencies that can explain to me the fundamental reason to invest in them. And I think that is just so dangerous. And then to tie it back into these ETFs, there's so many now that are leveraged ETFs on these cryptocurrencies. I'm like, there's going to be people that literally lose everything on these. I mean, there's so much risk in them. And you just got to be careful.
Well, the great thing about investing is there are so many things that you can invest in. You don't have to invest in things that you don't like or you don't understand. You find something you do like and you do understand and that has a very high degree of success. That's the thing that you want to be investing in. That also has a high long-term rate of return.
Yeah, exactly. I mean, it's investing when you fundamentally break it down is not overly complicated. But people, again, get too cute with it. They gamble with it, and that's where the risk ensues.